Welcome back to this week's edition of the RiskSpotlight Operational Risk News Update. My name is Emily Jones, and today I'll bring you essential updates and insights from the world of operational risk. All information is sourced from the RiskSpotlight Portal, the premier forward-looking service for operational risk content. Let's get started. It's an exciting time for crypto regulation in the European Union, where the Markets in Crypto Assets Framework, known as MiCA, came fully into force on December 30th, 2024. After years of fragmented rules in different countries, the EU now has a unified rulebook for all 27 EU member states. Many businesses are treating MiCA as a chance to operate in a more consistent and transparent environment. For instance, 4 companies in the Netherlands, MoonPay, Bitstate, ZBD, and Hidden Road, have secured MiCA licenses, joining others like Circle and Socios.com. However, not everyone has adapted smoothly. US-based crypto exchange Coinbase delisted Tether, USDT, pointing to compliance uncertainties around stablecoins. At the same time, across the Atlantic, President-elect Donald Trump has declared an ambition to make America the crypto capital of the world, with David Sachs and Bo Hines taking on key AI and crypto advisory roles. The big question is how different regulatory approaches in the EU and the US will shape the future of digital assets and the millions of investors who hold them. Shifting gears, let's look at some cyber developments in the United States. A series of alleged Chinese government-backed cyber attacks linked to Salt Typhoon exploited backdoors built into US telecommunications networks for law enforcement wiretapping, highlighting a major vulnerability. In response, officials from the FBI and CISA are encouraging Americans to use end-to-end encrypted messaging services like Signal or WhatsApp. However, this guidance conflicts with earlier enforcement trends by the Department of Justice and Federal Trade Commission, which have been strict about preserving data, even ephemeral messages, for regulatory and legal obligations. That means organizations must figure out how to implement or select enterprise-first solutions that balance encryption with record-keeping requirements. Meanwhile, in the UK, Barclays has revealed some eye-opening statistics on scams for the year 2024. Investment scams comprise 1/3 of the money claimed by victims, and purchase scams account for the majority of scam volumes. Most victims, 93%, were approached online, particularly on social media, while 75% of scam types originate on those digital platforms. Although 43% of people spotted scams and avoided losing money, many Brits, 52%, still feel overwhelmed by the breadth of scam tactics. Common lures include fake delivery and tax (HMRC) scams, but fewer people are aware of newer schemes like AI cloning scams. Another area to keep on the radar is SIM swap fraud, which has nearly doubled from last year to over 2,000 reported cases by November 2024, according to data from Action Fraud in the UK. Scammers collect personal details, impersonate victims to mobile providers, and port the phone number to a new SIM, giving them access to one-time bank passcodes. For instance, a victim might first notice suspicious activity like an unsolicited text from their provider about an eSIM update, followed by calls from a supposed fraud team. This tactic is so successful because many financial and email password resets hinge on text messages. Moving to Europe again, the European Banking Authority, EBA, published new guidelines urging banks to measure ESG risks more systematically, especially with climate pressures. The EBA wants banks to include at least a 10-year view in their analyses, factor in fossil fuel exposures, and align with net zero transition plans. This includes scenario testing for physical risks like flooding and wildfires, as well as transition risks. These guidelines follow a larger trend of rising insured losses worldwide from natural catastrophes and growing activism from climate groups in the courts. Some banks in the US appear to be pulling away from climate commitments, while European banks remain under pressure to stay aligned. Let's also not forget the ATM security challenges coming into focus for 2025, especially with the looming TR31 encryption standards. Financial institutions worldwide are faced with quantum computing on the horizon, outdated network technology, and new compliance requirements. To protect customer information and preserve trust, banks and ATM operators need to prepare for quantum-resistant encryption, stay on track for TR31 deadlines, and consider upgrading hardware that may not support remote key loading or cloud-based workflows. Finally, Netscope's recent study shows that phishing continues to surge, with monthly phishing link clicks nearly tripling from 2023 to 2024. Interestingly, attackers have diversified beyond email, using search engines, fake ads, and websites to entice clicks. The top phishing targets include cloud apps such as Microsoft services, as well as banking and telecom brands. That's significant because employees are often used to ignoring suspicious emails, yet might not be as cautious clicking on search results or banner ads. By the time an unsuspecting user clicks the link, they've already been led to a credential harvesting page that looks convincing. On the bright side, Netscope's data also indicates that many organizations are implementing data loss prevention controls for generative AI apps, reflecting a growing awareness of data security in new tech channels. Now let's turn to key operational risk loss events reported last week. The first update is about 53 state financial regulators taking coordinated action against Bayview Asset Management LLC and its affiliates, imposing a $20 million fine for inadequate cybersecurity practices and non-cooperation following a data breach affecting 5.8 million customers. Led by regulators from California, Maryland, North Carolina, and Washington state, the multi-state effort found that the company's IT and cybersecurity practices failed to meet federal and state requirements. The next update is about insurance companies. 3 United Health Group-owned insurance companies were asked to pay $165 million in damages in Massachusetts for violating consumer protection laws. The companies misled customers by misrepresenting agents as impartial and bundling unnecessary supplemental health insurance with major medical plans. United Healthcare plans to appeal the decision, which includes $50 million in consumer restitution and $115 million in civil penalties. The next update is about the Commonwealth Bank of Australia, CBA. It reportedly moved over 1 million customers to new bank accounts without formally notifying the country's prudential regulators, ASIC and APRA. This transition from complete access accounts to smart access accounts, announced in early December, has resulted in some customers having to pay fees to access cash through branches. Freedom of Information requests revealed that neither ASIC nor APRA have records of CBA approaching them about this issue in 2024. That concludes this week's Operational Risk Updates. For more on these topics and additional insights, visit the RiskSpotlight Portal. If you're a subscriber, log in or go to riskspotlight.com to sign up for a free trial. Thanks for tuning in, and until next time, stay safe and keep those risks in check.